God. All right. Let's let some people in. Some people's. People's.
Would you like some help, sir?
Good morning, Mr.
Morning.
Fulton.
Hey, Blake.
Blake Oliver. Where is he? I know I let him in. His
Yeah,
camera's
good.
off. Show yourself.
Good morning, Dennis.
Good morning.
You know what? I should start the process of going live on Facebook right now because it might be a while.
No comment.
And
Hey,
we're
guys.
going.
How's it going, Blake?
There he
Hello.
is. Look, he's at Griffith Park. Or is that Wildwood Canyon?
This is more the Phoenix Scottsdale area.
Oh, okay.
Yeah.
Other side of the mountain.
The other side of the mountain. That should be the name of my blog, my personal blog.
How you doing, Seth?
Very good. How are you?
I'm good. Enjoying the desert.
You like my hat?
I love your hat. That reminds me of the Dr. Seuss book that I'm reading with my son right now. Go Dog Go. Quite a classic. There's Oswald.
Oswald is here. All right. I think Facebook is actually going to play nice today. Imagine that.
I'll be right back, guys.
All right.
Sorry about being late.
Fired.
Oh, no worries. Glad you're here. We're just glad you're here, Greg.
Me too.
We'll take what we can get.
Good morning, Courtney.
Good morning. How are
Hi.
you?
Awesome.
Like the hat.
Thank you.
You're
It's called I Need a Haircut.
That's how you camouflage it, huh?
Yeah, fortunately, my wife cuts my hair, so I have to worry about getting it cut.
I got mine cut by my wife, and she did a great job. But
Oh, but
I just kind of rolled out of bed this morning. So, plus I wanted to represent with Giraffe, so I threw the hat on.
So what I'm hearing the comment thread is I don't have a wife. Is that where my problem is? Or?
Yeah, that's your problem. You need a
what's your
wife,
problem?
and you need to make sure.
My problem is I don't have a giraffe hat, Blake Oliver.
He stepped away. He didn't hear your request.
We can replay it for him.
And you also need.
I heard it. I
Oh,
heard
you
it.
did hear it. You also need one of these, Greg. We need a numbers guy giraffe.
You know that I had that in my possession at QB Connect.
Yeah.
Not that one. I had the real one.
So as the guy at Jirav with access to the print-on-demand hats, I will send a hat to anyone who signs up.
There you go.
So that's the special.
All right.
So it seems
No
that
3 free months. Just a hat.
Just a hat. A hat is better than money. These hats are limited edition. You know. And you
Interesting.
can already get the free months without asking me for them. So
All right.
the only control I have is power over swag.
That's good power, though. It's really good.
So you got to use it for good,
Not for evil.
not for evil.
All right, I'm just trying to get when I set up the live Facebook feed, I opted to share it to the group. It doesn't seem like it went to the group, so I think it will now because I just manually shared it to the group. And if you're wondering, I'm talking about the Accounting Business Academy group on Facebook. All right, I think we're good. Guess what, everybody? We're live. Great, perfect time for me to get a frog in my throat. Okay, take two. We're live. Happy Friday. It's May 22nd, 2020, and we're here to talk about cash flow forecasting, but specifically how to build wealth for your firm and for your client's firm. And there's a madness to my method, and there's a method to my madness in terms of what I plan to share with you today. So good morning. I hope everybody's doing well. We're still in the middle of the zombie apocalypse. I've designated a couple of my friends here as co-hosts. Please help me let people in if you see them. Blake, I'm going to make you a co-host too.
Okay, I'm on my iPad, so I don't know if I'll be able to help in any way. But
not for that reason, but since you actually are here kind of representing Jirav, I didn't know if at some point you might want to share a few things with us, share your screen. But if not, no big deal, because I've got an excellent program planned for everyone today. Now, and before I even dig in, because as I was kind of preparing this morning, I was looking and I just wanted to, and I'll show this to everybody. When I go into the setup in Jirav, there's a lot of different types of connections you can create in terms of course, accounting software. You can import from spreadsheets, but I also noticed some interesting ones, Blake. So right off the top, I kind of wanted to ask you about this. So I see, for example, payroll products like Gusto and ADP. How does that figure in terms of a connection in Jirav? Would that be supplemental to the accounting software, or could I use Jirav to just build projections around payroll expenses, like for poop loans that we're doing these days?
yeah, we're really excited that we have just released, I think it was earlier this month, the Gusto integration. Mm-hmm. So that is a native Gusto integration. We're the only business intelligence / forecasting tool to have that. And so if you've got clients on Gusto, you just connect like you would connect to QuickBooks Online or to Xero. We pull in that staffing list with the hire dates, termination dates, salaries, names, and roles.
So you can get your head count done that way.
Yeah, and so that head count data goes into your staffing plan in Jirav. You can build out KPIs on the dashboards using head count. And we've got some like native ones like cumulative salaries, cumulative head count by department, new hires, all that stuff.
Beautiful. So I can, like, the first thing that pops into my head then is, so I probably connect QuickBooks Online, let's say, and Gusto, because Gusto is going to get me that detailed payroll data that I want, so I can look at things like revenue by employee, which is one of the key metrics that we often want to look at, to see how efficient is my labor force, right? Or how is the efficiency changing? Are we getting more efficient, less efficient, so on and so forth? And that's one of the keys that I like to make clear right up front when we're talking about forecasting, and especially when we're talking about looking at KPIs. I think it's really important to remember that it really always has to be looked at on a comparative basis. Just to look at revenue per employee doesn't really tell me anything. I might give me some idea of something, but the reality is it's only when I start looking at it on some kind of a comparative basis. I can compare it to an industry standard for my industry. I don't even love that. Personally, I prefer to compare myself to myself. How am I doing today versus yesterday? How am I doing today versus where I want to be in 6 months or a year from now, right? That to me is the key when it comes to KPIs. I almost like to go as far as to say, even if just to make the point very clearly, that a KPI on its own without being compared to anything is sort of worthless, right?
Exactly. Trending the data is one of the most important things that you can do. So, show the previous 6 months of that trend and see if, is average revenue per employee declining, which it may be doing in this time. Do you need to reassess your staffing needs? Like
Right.
you can't make that determination unless you look at the trend.
Exactly. So here's the thing, and here's where I'm coming from on this. I've titled this Cash Flow Targeting, How to Build Wealth for Your Clients with Jirav. And I chose that title very specifically and carefully in terms of what I'm driving at here. When you set up forecasts or projections and you set them up the way most have done over the years, you set them up based on income and expense goals, essentially. And then you're setting a target really based solely on the profit and loss, which won't necessarily build wealth, right? And just work with me here. And even if you take your quote unquote profit first, right, in your big picture plan, that doesn't necessarily mean you'll build wealth for your company. In fact, it almost implies that you won't, because it's a plan based on taking the profits out of the company before you've even earned them, right? So, these are things I've given a lot of thought to over the years, and bear with me, I'm just going to rearrange my windows here. So when you set a cash flow target, you're creating, and that's what I mean, when you specifically set a cash flow target, not just the income target, but cash flow, then you're creating a plan that's based around building wealth. And this is where we can have maximum impact for ourselves first and then for our clients. Now, recently in 97 and up, I put together a bit of a catalog. I'm going to actually share this on my screen with you. 1 second. So in 97 and up, I recently put together this catalog, and sorry, I'm just seeing we have people in the chat. Oh, okay. Thank you, Greg, for answering the question. And I usually try to be very careful not to leave acronyms hanging without explaining what they stand for. So yes, KPI stands for Key Performance Indicator. They're sort of high-level metrics that we use to analyze companies, right? And we'll explain a little bit more about that, during the rest of the hour. So on my screen here, you can see this is for 97 and up members only. So of course, the implication is join 97 and up, you'll get access to what amounts to over 10 hours, because each of these is about an hour. Oftentimes we go over the hour though. Excuse me. So it's more than 10 hours on cash flow, starting off very simple with how to create a simple cash flow analysis. That word copy is not supposed to be in there. Beginner financial modeling, payroll modeling, right? Payroll modeling part 2. Then we looked at debt service. Then we looked at the balance sheet, the statement of cash flows, recapping the statement of cash flows, and then next steps once you get everything balanced, and then getting away from the COVID-19 panic hype, and it's 90% mental. And we got into more cash flow modeling because that was, to me, the better thing to focus on. And, of course, I understand that we have to focus on helping companies with these loans, but my point was, in the bigger picture, I want to place more emphasis on doing this kind of stuff. This is how I can help companies navigate the waters and get out of it and get them thinking about what are some creative ways we can bring in money. I've seen some really impressive things done by some really impressive companies over the last few months where they were able to take a situation that they might have been in that any normal person would have easily said, hey, you're dead in the water, just ride this out as best you can. And they didn't. They didn't give up. They got creative. They figured out ways to make money even in a time like this, even in industries where you would expect they would be dead in the water. And to me, this kind of stuff, doing the forecasting, is where we can add the most value. The loans are just a Band-Aid. This is the permanent fix in terms of the direction that we're going in and how to navigate that, how to get from where I am today to where I want to be in a year or two from now, let's just say. Right? So to me, this is a much higher value thing to focus on than just to focus on processing Paycheck Protection Program loans, which I've really just grown to loathe. What?
You said it.
I said what?
You said the whole name and not just.
I did. Sorry, poop loans.
Does that mean we all have to drink our coffee?
Yeah, we all have to take a shot of coffee.
Mm-hmm.
That's fine.
Give me a lot of coffee too.
You're filling out my bingo card really early in the morning, Seth.
Sorry. Good. I'm glad. I want everybody good and caffeinated so that we're focused and paying attention.
Good.
So, so again, I feel strongly that, well, actually, let me back up. So again, I think this is a much higher value thing to look at with clients. Of course, we do what we have to do as far as the loans go, but we should go a step further. And I've even had, as many of us have had clients in the accounting world who've come to us and said, hey, we got to cut back. I've really made an effort to turn those conversations around and say, no, we don't, not only shouldn't we cut back, we need to actually expand, right? Instead of going into a mindset of contraction, we need to go into a mindset of expansion. And this is how we do that. You know, and for years we've heard people forgetting about COVID long before. How many years has it been that we've heard all kinds of quote unquote thought leaders standing up and saying, you need to become the strategic advisor. You need to be more advisory and less transactional in your accounting practice. But that's about as far as anyone ever goes with it. They never really, they tell you what to do. They never explain how to do it or even come close to explaining what that looks like. So this is what that looks like, what I plan to show you over the next hour. This is exactly what that looks like, right? And Blake knows that for many, many years, I was stuck in my spreadsheets for doing this because nothing replaced the flexibility or the power and control that you had with a spreadsheet, especially if you really knew what you were doing in terms of writing even just fairly simple formulas in spreadsheets. Getting the balance sheet and profit and loss and statement of cash flows to balance is the biggest challenge. But once you do that, you know, it takes some work, but I can build out the formulas and flow the right numbers to the right places and have control over it. And if something's wrong, I can easily understand how to find and fix those things, right? All the tools I looked at before about a year and a half ago, maybe something like that, never really, there were some good ones, some decent ones that maybe gave you some pretty pictures of how things are going to look, but nothing really ever sufficiently, in my opinion, replaced the power and flexibility I had as long as I know what I'm doing in a spreadsheet. And then Jirav came along. So, but here's the thing, and I'm going to say this, and I'm curious, Blake, what you're going to think when I say this, because I don't know if we've ever discussed this next thing I'm about to say very specifically, but here's the thing. I feel strongly that before you get into a product like Jirav, you still need to understand the fundamentals of how this works first, right? You really do need to understand how the P&L and the balance sheet and the statement of cash flows come together and what that looks like. And again, this is where I'm going to throw my opinion into the ring here, and maybe I'm going to stick my neck out, right? But I think that you should be able to build a set of financial statements in a spreadsheet environment so that when you get into a product like Jirav, you have the foundational understanding of what needs to be done and what it should look like. So, because, you know, and Blake, correct me if you, you know, and feel free to disagree or qualify it, but I think that you won't necessarily know whether or not you're really getting the right result out of Jirav if you don't have a really solid understanding of how the numbers flow between the balance sheet and the profit and loss and ultimately the statement of cash flows.
I agree 100% with you. And what you're touching on is really one of those kind of like fundamental distinctions between finance people and accounting people. Mm-hmm. And there's like all these finance people out in the world who never took accounting or just barely passed it, that really have no idea how anything works under the hood, right? It's sort of like driving a car and maybe understanding the metrics of horsepower and whatnot, but not really knowing how the engine works. That's the analogy I would use. So if you're going to do finance type stuff like forecasting cash flow and being an advisor to your client, which, you know, that's more of the, you know, finance side of things, then it really helps to know how the financial statements all tie together, what entries are happening behind the scenes. You'll have a hard time doing financial modeling if you don't know your debits and credits.
Right.
Yeah.
Yeah, because ultimately I can set up, you know, and I'm going to show you today how to set up drivers in Jirav, but I won't necessarily know if I'm getting the wrong result, if something's not flowing to the right place on the balance sheet. And then, like I said, ultimately in the statement of cash flows, if I don't really understand how to set the right expectation about where it should land, right? In other words, if I don't know what the right picture should look like, it's going to be hard to notice when I get the wrong result, right? And
the good news about Jirav is that, like, unlike a spreadsheet where you can have stuff, your balance sheet can fail to balance, in Jirav, that's impossible. So just like with QuickBooks, we prevent your financial statements from going out of balance. Although actually, now that I think about it, there are plenty of situations.
We've seen balance sheets go out of balance in QuickBooks.
So you need to know how to fix it, but it's hard to do. Yeah.
Yep. And then, you know, so Jirav, you'll get an error if you're trying to do something that's going to screw up your balance sheet before you actually screw up your balance sheet, right? And, you know, we won't be able to get into something as detailed today as like the debt service modeling. But I have to tell you, that was what initially thought was still going to be a problem in going to Jirav, because I had a client very specifically that I was looking to move into Jirav, and he has a very heavy debt structure. In fact, that was part of the plan I was trying to put together with him, is we wanted really clear visibility into all of his debt instruments and what the interest cost was and how quickly he was paying down the principal and how much that was taxing his cash flow, his working capital. And ultimately, how long were we going to be able to, in what period of time were we going to be able to pay all this off? And also, when you can see a debt structure with the right sort of bird's eye view, you can start to analyze how can we move money around to save money on interest and to maximize the, the sort of efficiency of the whole debt service plan, right? And because the challenge and it's almost like there's an art to this where you have to balance paying off that debt with not sucking up every last dollar of your free cash flow, right? And so it's really important to be able to have this visibility. And I thought, all right, Jirav is really good and cool, but am I going to be able to easily build a table that analyzes, here's what the interest rate is, based on that, here's the monthly payment, and based on that, here's the split, how much of it is going to principal versus interest, especially when that amount changes every month. But I'll say this from my experience, and I realize this is going to start to sound a bit like an infomercial, but I'm going to share my screen and walk you through it all so that it's not an infomercial, but rather an educational experience. But ultimately, what I want to say about that, and this is the ultimate thing that kind of pushed me over the edge and said, okay, this is it. I can leave my spreadsheets behind and go all in with Jirav, is Evan from Jirav was able to walk me through in a series of one-on-ones how to build the custom tables that I needed to make the whole debt service thing come together. And so, yes, there was a learning curve. Yes, it was front-loaded. I had to put a lot of time and effort in up front. But now that I've seen how to do it, I can recreate that at any time I need to. I'd probably have to spend a little bit of time if I was going to go back in and do another debt service structure for somebody today. I'd probably have to spend a little bit of time studying what we had set up. But ultimately there's a logic to it that makes a ton of sense. And so the bottom line and the point I'm really trying to make in the bigger picture, without you expecting to understand all the details of how this all works, is that this stuff does work, and that there is a definite logic to it and it makes sense. But here's the most important thing though, because I started off by talking about how I'm doing with Jirav, I'm able to do cash flow targeting specifically versus just income and expense targeting. And the main difference here is, normally, and especially in my spreadsheets, I can't really analyze this stuff until after the fact, right? I have to wait till the month closes, because only then am I going to, sort of run the updated, run the updated financial statements in QuickBooks, export them to Excel, drop them into my spreadsheet templates, and then do some variance analysis and see how did we do in the actual numbers compared with what our projected numbers look like, right? It's too laborious to do that more than once a month because I have to adjust for changes in the account structure and a number of other things. So the difference was, and this is where I saw how I could make the transformation from income and expense targeting to cash flow targeting, which is based on, and let me just kill off Slack so these notifications don't pop up on my screen every 2 seconds. Jirav enabled me to make that transformation, because with Jirav, I'm pulling in the data in real time from QuickBooks Online, which means at any given point in the month, I can run my variance analysis and see how am I doing so far compared to the total, which means I have time to react before the month is over and make whatever adjustments I might need to make. If I'm over in a certain area, I can go figure out what areas I can work on coming under in to make up for that, right? So the idea is, if I can hit my cash flow target each month, then of course my cash flow goal for the year will take care of itself, right? And that's the name of the game here. So I want to walk you through, what I've been doing in 97 and up, and then we're going to take a look, of course, into Jirav. And I want to do this so you have the real context for exactly what, Blake and I were just discussing in terms of really being able to do what I'm going to show you here first to build that foundation, so that when you get into Jirav, you'll understand exactly what you're doing there, right? And you'll be able to sort of make the transition. So in this first tab I have, and this is very simple, compared to how complicated this could get, but I have what are called drivers, right? These are basically assumptions. And this came out of the fact that we did a payroll model in this, this sample model. Looking at payroll, we had to have a driver for the Social Security and Medicare percent. Now that doesn't change much, but still we want anything that can be calculated by formula, we want to set up a formula for that, right? we set up the threshold for where, what do you call it? Social Security phases out, which I think we said it was probably still around 120,000. I forgot. And then we have an assumption here about accounts receivable turnover days, which is used in calculating, how accounts receivable converts to cash at what rate, right? And then what we did was we just made an example. We built a sample profit and loss out, right? And so again, this is very simplistic, just to get the layout done, just so you can see how this works, how it comes together. Little by little, we built this out. So if you look on my officer salaries or staff salaries in this payroll section, look in the formula bar, it's coming from a schedule we created called PL, which stands for, P&L, profit and loss, dash payroll, right? So this is how I've walked through, again, in about 10 hours, how to build out something like this in a spreadsheet in Google Sheets, as you can see, right? So we have a model for insurance, because then once it's built, I can take any line item from the P&L or balance sheet and create a template like this where we can, plot out very specifically what the cash flow is going to look like on this, right? And for now, we kept it simple. I didn't take the prepaid aspect of insurance into account, but we could, because this is the cash flow. I could easily build out more schedules that said, okay, we're paying for our key employee insurance on June. That's a 6 months worth of premium. So now we need to flow that over to a prepaid and amortize it, right? Because we're paying up front for 6 months. We're not actually incurring the whole expense all at once, right? And then from this, we carve out a template for a P&L account. Here's the payroll model, right? Where we list out all the different employees and how much money they're making. Okay, and then we have a column for department, and down here we summarize by department, so we can, in the case of an S Corp, flow the officer's salary specifically to the officer's salaries line on the P&L, and of course the difference goes to the staff salaries, right? And then here's where we're calculating the Social Security and Medicare tax. This I bring in by formula from those drivers, but it's just for presentation, so I could see in this schedule exactly what's being used in the calculation. Right, and then we started plotting in like a phase out for the Social Security, and so, and again, you have to be pretty good with Excel or spreadsheets in general to build this kind of stuff out. Here's the balance sheet, right? And of course, once we get into any projected period, we started this in March, so March was still projected when we first built this out. So this is pulling from the statement of cash flows, right? And then we have the balance sheet account template. The balance sheet account is different from a profit and loss in that it has a starting balance, it has activity, and that gets us to an ending balance, as opposed to a P&L account, which just kind of closes out each month. It's just a total. Then we showed how you can build out a schedule, for example, for the owner shareholder distributions, right? We said, okay, well, since the extension for this year on the tax deadline, we might be pulling out a big chunk of money in distributions to pay taxes. And so using a tool like this, we can plot all this out and plan for it cash flow wise and say, okay, we're going to take a tax distribution of $20,000 on top of the normal monthly distribution of, say, $5,000, right? And of course, this all flows over to the balance sheet. Down here, there's your owner contributions or distributions. Just to keep it simple, I flowed this over in total instead of separating contributions versus distributions, right? But you can see when we get into the projected period, it's actually coming from the balance sheet template. It should be coming from the actual schedule. But then ultimately we get to the statement of cash flows, which of course starts with the net income, right? And then it looks at the changes in the balance sheet accounts. This is where it starts to get tricky, because we're so used to looking at these financial statements and understanding things in terms of what their balance is or what their total is. Here it's not balances and totals, it's changes in balances in the balance sheet accounts, right? And so I'm not going to get into that whole explanation. I've done it many times before because I want to stay focused on the big picture of developing forecasts, and I want to jump into Jirav in a minute. But ultimately, the statement of cash flows has to balance so that we get our ending cash balance here, and that flows over to the balance sheet for the projected periods, and everything has to balance. So the cash at the end of the period, according to the statement of cash flows, has to equal the cash at the end of the period from the balance sheet. So over here, I run a check and make sure that my difference is 0. Similarly, the balance sheet needs a check to make sure that your total assets is in agreement with the sum of your liabilities and equity, right? So, and again, this is one of the challenges of not using a tool like Giraffe, because I have to make sure constantly that this stays in balance. And if it doesn't, it means a formula is broken somewhere, or it means that, for example, I've added in a balance sheet account on the balance sheet, and I forgot to account for that in the statement of cash flows, right? Anytime I add a balance sheet account, I'd have to go add it into the statement of cash flows and, you know, factor that into the flow of how we get from net income at the top of the statement of cash flows to ending cash at the bottom of the statement of cash flows, right? So again, all this was to say that you should have a good enough understanding of this stuff to be able to build something like this yourself in a spreadsheet as almost like a prerequisite. Then we can jump into Giraffe, and Giraffe signed me out. So let me sign back in.
And I just want to add to that, Seth, that I find that building the custom tables in particular in a spreadsheet first is a great way to make sure that I understand what I'm doing before I go and try to build it in Jirav. So I think that's like totally the right way to go.
Yeah.
And I want to say too, while you get that going, my team has double booked me. So I have another meeting I have to get to, and I'm really disappointed that I'm not going to get to be here live for this, but I can watch the live stream recording, right?
You can. The recording is, we're live streaming on Facebook, and then of course I'll upload the recording to YouTube, Vimeo, and my website, you know, over the weekend.
All right, I'm gonna have to tell my team like they're idiots. If they saw this on my calendar, you know, they can't do this to me. But
no worries.
Really appreciate you featuring us, and anyone who's watching, you know, if you are curious, you know, you want to reach out and chat with me, you're welcome to do that. You know, I'm a CPA who never did forecasting until October when I started joining Jirav, and like my secret mission joining Jirav was so that I could get paid to learn how to do it, because I think it is the future of accounting.
Yep.
So, all right, guys, thanks so much.
All right, thanks.
Bye, Seth.
Really appreciate you taking the time. Okay, so here we are. Here's Jirav, and I'm in the initial setup screen, right? And as you can see, there's a lot of products. We mentioned Gusto. There's a lot of products you can link up in Jirav, right? Of course, I'll focus on QuickBooks Online. If you're wondering, no, it doesn't connect with QuickBooks Desktop. And you're seeing more and more of that kind of thing where developers of apps and products are not developing for connections to desktop because they just, there's not value in it. There's not enough value in it for them to do that. You know, you're still seeing some, but not, it's less and less, and it's going to diminish as time goes on. You're going to see fewer and fewer apps being developed for QuickBooks Desktop, and most of them are going to be developed for QuickBooks Online, because ultimately, I don't think there can be any question that that is the future. So, really easy to connect QuickBooks Online. Of course, I've already done it here. If it hadn't already been connected, it would say connect. And once you do that, you're going to walk through the normal process. It's going to launch the login screen. You'll log into your QuickBooks Online account. You'll choose which company you're trying to connect to. But the other thing I can use this for is, let's say I'm going in now and I want to do, I want to update my variance analysis. I want to look at the month-to-date actuals versus projected. And I just finished updating bank feeds in QuickBooks Online, 5 minutes ago. Then I can click import, and I can go and say, hey, let's just make sure this is completely up to date through today, and choose import, and it's going to do just that. It's going to ping the QuickBooks Online company and load up the latest data. There's my friend, the Giraffe. He goes in there, he bangs the keyboard a few times, and we should be all set up. Now, the sample company I've linked this to has very little data in it because it's just a sample company. Let me show you the dashboard, though, real quick. And you can see this does start to populate because there is some data in the sample company that I've linked to. And so if you like KPIs, if you're a fan of that, here you are in the dashboard. This is no setup required. This is kind of the default setup. Of course, you can add tiles to this, right? And you can certainly edit anything in here. If you move your mouse over any of these, there's this ellipsis, which you can use to edit. Copy it to make some changes and look at different versions. You can move them around. So this is completely interactive and editable, for lack of a better word, right? So that's the first thing you kind of see. It's, and it's going to show you some really cool visual stuff, especially if you're working with a client who's not a numbers person and wants to see the visual side of it. Very, very easy to do that here in Jirav. But what I want to focus on for the rest of today is how to start building those projections in Jirav, right? Because everything I just walked you through in terms of the spreadsheet setup, that's the stuff Jirav does all for you. But like I said, and Blake confirmed, it's important to understand that so that you understand when you set up a driver in here that you should be able to predict how it's going to impact balance sheet, profit and loss, statement of cash flows. And that way, when you finish setting up the driver, you can run the projected numbers and make sure that it's working in the way that you expected, so that if it isn't, you'll recognize that and then you can troubleshoot, right? So with that in mind, what I want to do is we're going to come over here to where it says plans, okay? And the plans is just that. You can create different kinds of plans. You can create different scenarios and say, I want to look at a conservative scenario, a moderate scenario, and an aggressive scenario, right? So you can use this in a lot of different ways. It's also a way when you manage your plans that you can say, hey, I want to carve out this exact moment in history and say that, you know, as of today, let's say I ran everything through April of this year, and I want to kind of carve that out, and it's almost like saving a document that shows what everything looked like January through April as of May 22nd of 2020. So I can carve out a plan, and when I go to manage plans, right now we just have the one, but I can add a new one that would say this plan is going to be based on an actual start date of January. The forecast start date would be May, and I can just carve it out and preserve it while maintaining this still as the ongoing current plan, right? So, and so when you go into manage plans like I just did, you can easily add new, and you can, you know, I can do like a Q1 plan and say, show me everything. I want to see the actuals from January through March, you know, Q1, and I'll preserve that here while this becomes the you know, the main ongoing plan, because I'm going to make changes to this plan. As I run variance analyses, I'm going to make changes to the drivers. So what I'm doing by saving these is preserving what the drivers looked like as of that point in time, right? So that's really important to know, A, that you can do that and how you can do that, right? So for now, we're going to focus on, because this is, you know, the scenario here is we've got a brand new setup that we're doing. And so I'm just trying to get everything right now kind of loaded in from January through May, or really from May forward now, so I can start building my projections and then pull in my QBO data to do my comparisons, right? So the actual start is January 2020. Very, very simple dialogues here. The forecast start date is going to be May, and you're going to see how that, you can actually start to see in the background, bottom right of my screen, you can see how this plays out. It shows you, and that's based specifically on what I've got set up here. It shows you the actuals go through April, and it shows you the forecast start point, and it shades in the headers, very similar to what I've done for years and taught for years in Excel. I've always shaded in the headers over the forecasted portion compared to the historical, so it's very clear and visual, you know, where that breaking point is, right? And so I'm going to set that up. I'll hit discard because I don't want to change anything. And here's where I can establish the end of the forecast period and say we're forecasting through December of 2021, right? And then I can name the plan and then a short description. Oftentimes, you know, this is going to be a bit redundant, but these just show up in different places. So I'll close this because I didn't actually change anything, but that's how you set up your plans. And once you've set up your plans, then we want to go alongside here and start looking. You can look at the plans based on the different components of the financial statements. I can focus specifically on revenue, cost of goods sold, and so on. But if I go all the way to the bottom here where it says drivers, I get the complete layout. Okay, and again, it's broken down by area of the financial statements. CapEx is capital expenditures, right? So your fixed assets, basically. CapEx assets, sorry, and this is CapEx is capital expenses. Allocations, Blake talked about staffing roles that you can set up because you can pull in your payroll data so that you can do payroll related analysis. Again, it's really powerful stuff and you're not going to learn it all in one day. So I want to focus on, you know, perhaps the most exciting piece, which is the revenue. So I'm going to click here where it says add, and I can start creating my revenue drivers. Now, here's where you have to stop for a minute and ask yourself a few questions, you know, namely things like, how do I bring in revenues for my company? What's the main driver of revenues, right? If I'm a marketing company and I charge flat monthly fees for my marketing services, then the main driver is probably going to be my customers, right? And so one of the first companies I had set up in Jirav was exactly that. It was a marketing company where he had, that was his exact business model. So when I thought about it, I said, okay, well, and I like this example because it will kind of get you into this in a use case and a model that's very simple to understand, right? So this first revenue driver might be Parkway Business Solutions, right? All right, and Parkway Business Solutions is going to be one of our clients that we're offering marketing services to. And as soon as I hit the tab key to finish creating the name, it moved me over to the next box, right? And now this dialog pops up. And so now I have to tell it, I have to give it some information, right? What's the category? It defaults to revenue because that's the section we're in. So presumably, you know, that's what I'm creating a driver for, is something for the revenue category, right? I have an option here. Do I want to round it or not? So the default is none. We'll leave it that way. You can have departments, which can be really useful because you can use those departments and display them in reports. You can get department totals, right? We'll leave that alone for now. And then over here, you're going to establish what account is this going to hit. So we're creating a revenue driver. So the account probably should be some kind of a revenue account, right? And for now, because again, sample company, simple chart of accounts, these are pulled in from QuickBooks Online. So this will be your exact list of income accounts, revenue-based accounts, right? Based on what Jirav pulled in from QBO. If you update or add an account in QBO, you go back to what I showed you a few minutes ago, run the import, and it will be up to date instantly over here, right? So we'll just assign it to sales for now, okay?
You should probably just leave it as bad debt because it's math.
I would have to second that. I would definitely have to second that.
Perfect. All right, bad debt write-offs it is, right?
Is
So,
department the same as class?
No, it's different. Department is strictly an internal thing that's used in Jirav. It has nothing to do with like classes or locations in QuickBooks Online. It's just a different thing. It's a reporting unit that you can use in Jirav. I'll give you a quick example of how I was able to use this. When I was setting this up for a different client at one point, we had some commissions that needed to be calculated, but the commissions were only paid on certain customers. So I put those drivers for the revenues for those customers into a commissionable department. And that way, when I created the driver to calculate the commissions, its starting point was taking the department total called commissionable department, which is the total revenues in that department, and then multiplying that by the commission rate. So this is strictly an internal Jirav reporting unit that can be used in, you know, the way I just described is one really good example. Does that answer the question?
Yes,
Okay.
thank you.
You're welcome. All right, so the frequency will leave. You can use this to say do it every other month, right? But we're doing it, you know, monthly, so we're going to use a frequency of 1, right? We'll come back to that. That's for more advanced stuff. So once I click OK, we've now told it where to output this driver to, but I still haven't established how that's going to be calculated, right? So so then you have the driver and the function and then the rate, right? Right now, my rate is set at a constant of 1, right? So the driver might be, what is this client's monthly fee going to be? So when I click in there, okay, hold on a second. Okay, so when I click in there, right now it says the category is revenue. I'm going to change that to a constant, okay? So if I could leave this as, because I could base this driver on some component of revenue, like I said, for the commissions, for example, right? But what I want to do here is I want to make this a constant, and that way I can put a value in here, any value I want, and say, well, what are we going to charge Parkway? I mean, he's not going to pay us anyway, so it doesn't matter. But let's just say we're charging him $3,500 a month. Oops, my number lock key is turned off. So $3,500 a month. And notice it gives you the preview down here. It kind of populates based on your settings. Save. Okay, and then, so now I have $3,500 a month times a constant of 1, of course, is going to give me $3,500 a month. Okay, the start date would be the cutover date, which I already showed you in the plan is going to be January of 2020, right? So by default, everything's going to start on the starting date of your actual plan, but I can change this. I can say, hey, Matthew's not going to be a client until next month. So I can set this ahead of time and say, next month, we're going to start with Matthew's monthly revenue, right? And then the end date is useful if I know, let's say this is just a temporary project and it's going to go on for 6 months and then we're done, I can set the end date accordingly. Or if Matthew calls me up and says, hey, you know what, you guys suck at marketing and I'm firing you after this month, I can go in here and set the end date and say, well, after this month, we're going to lose Matthew's business, right? And then the description is, again, just that. It's an internal thing. I can write a description saying, you know, driver based on monthly fees or something like that, on flat monthly fees.
And you wonder why I didn't pay you. Jeez.
I know, seriously. Seriously. And then I moved back. I did shift tab to go backwards. So when you tab through the fields like that, it just pops up these dialogues. So I'll just hit discard because I don't actually want to change anything there. Okay, and there's no save button. It's pretty much saved as you create it. But before I go further, what I'd like to do is see how this is working. Did it do what I expected to? What I expect to see now is projected numbers, essentially starting with May, right, that show $3,500 a month revenue coming in from Matthew. So a couple ways I can do that, one of which is to click up here where it says revenue. Okay, and it gives you a graphic version of it, but down here I have my revenue table and you can already see the $3,500 a month. You can also see from this arrow that it's just giving me the total, but if I wanted to, right from this table, I can expand it and I can see the details exactly where this driver is coming from. So as we add more drivers, they'll all appear down here in this table. And for that matter, if I wanted to, I could double click this. And from this screen, I can go right in and edit the driver. If I see, hey, there's something wrong. Wait, it's not $3,500 a month. We're going to give them a break. Let's make it $2,500 a month and save that. And you'll see now that, of course, it updates and saves. So this is how you can quickly confirm that the driver that you set up is, in fact, working. Right, so let's go back to our drivers table and let's add in one more client. And so over here, and watch this. This is, again, it's one of the reasons I love Jirav as a product and as a company is it's kind of like what we've been saying a lot about ClickUp lately. Like there are certain apps you run into once in a while where the more you play with them, the more you just get hit with this notion that it's like they've thought of everything. It's like they really took their time to think of everything. I want to be able to do this fast. If I'm in a spreadsheet, I can take a driver like this and maybe copy and paste it down. So here's kind of the equivalent of that. When I move my mouse over the existing driver, notice the hamburger menu that appears to my left. When I click on that, I can clone the driver. Okay, so now it makes a copy, exactly the same thing, but now I can go in here and say, we're also going to get the numbers guy as a client. Okay. And for Greg, let's see, Matthew, what should we charge Greg each month?
I mean, he's got money, so I'd say like $5,000.
Wow. Okay. All right, $5,000 it is.
Rolling in the dough.
Rolling with the homie. Anyway, you can also resize these columns, right? Sometimes. You're supposed to be able to resize these columns. It could be my browser on the fritz, of course. But you can see how that should work. I'll talk to them about that, maybe if I refresh my page. But anyway, now if I go back up to my revenues tab, I'll scroll down. And you can start to see how like the May graph is populating. April's big here because that pulled in the actuals from my sample file, and I've got a bunch of revenues in there for that. But now you can see it's $7,500 a month. And notice it gives you the grand total up above. Again, I can see the total $7,500 based on my sales drivers. And I can click and expand this. And again, I can get at the details from within this dialog. So now I can see how it breaks down. I've got $5,000 a month from the numbers guy. And I've got $2,500 a month from Matthew. Oh, there's close. I was looking for that. And you can drag the slider out and just see how far out it goes. So let's go back to the example I was referring to, where let's say Matthew's was really just based on a temporary project. So I'll go out here and I'll say this is going to end in, let's say, December of 2020. So you have to first change this from, because the max date is just that. Remember earlier when I set up the plan, I established that the projection end date was going to be December 31st, 2021. So if I want to change it to something specific, I have to change the drop down from max date to a specific date. And then over here, I can say, let's just go till December of 2020 and save that. And now if I go to the revenue model preview, it's $7,500 a month until December. And then notice in January, we're only seeing Greg's $5,000 a month there, right? So that's how that works. This is, again, I'm showing you because it's just, I'm giving you, a start at this. I'm showing you just very simple how we can do this. Now, let's say, because I mentioned this earlier, let's say that Greg's income is only going to be every other month, right? For some reason, that's just what we've arranged with him. So let's go into the numbers guy.
This is the revenue, not talking about the fact that I take 360 days to pay you, right?
Right. No, this is forecasting. So we can get into the accounts receivable assumptions to account for the possible delay in, when we're actually going to get paid.
Oh, there'll be a delay.
Yeah, so I'm just looking at the comments in the chat quickly. So, one person suggests that I might want to show the end result and then go back and show how to create it. The challenge that presents here specifically is it's already created. So I can't, I could show you additional ones possibly, but I really wanted people to be able to see how this looks from a blank and how to kind of build it up going forward. But I understand the point, that it might be exciting for people to see how beautiful this can look when it's all filled in and then go back and redo it. But I'd have to sort of gut all the stuff out to go back and show you how to create it. So that's why I normally do it this way. But now, so I wanted you to get a sense of how to create these. Now let's go into the numbers guy here. And remember, I said the frequency was 1. Let's make it 2. And I didn't like what it showed me in the preview there.
Why not?
Because it should have in the preview shown it going out every other month now.
It is.
Oh, I didn't, in my preview, it didn't look like that, but you can see here it worked. In the driver, I didn't see it alternate. Anyway, maybe my eyes were tricking me. But now you can see, it's 5,000 in May when we start, but then it's only 2,500 because Greg's paying us only every other month, right? So that's how you can deal with, any kind of non-regular frequency of payments, right? Or of revenues. Okay. Now let's look at operating expenses, right? Because again, that's going to, in terms of the layout and the structure and how to build a driver, it's going to work very similarly, right? So we can see it's, when I go into the OpEx table, it's showing me the gross margin, which at this point is just the revenue because we didn't put any cost goods sold in there, right? But I can go into, if I go down here, this is why sometimes if I'm going to build it initially, you can build the drivers out right in here like I showed you, but I find it easier to go all the way to the bottom here to the actual drivers table and then go into OpEx and we'll add something here, right? So let's do an easy one. Let's do like monthly rent, right? So since I'm in the OpEx section, it's going to show me the OpEx category, which means when I get to the accounts, it's going to show me OpEx accounts. And there's rent and lease. Again, this is pulled in from QuickBooks Online specifically. We're going to pay rent monthly. So I'll hit save. And again, the driver would be the monthly rent, right? So pretty simple there, but we're going to do a constant. And we're going to pay $2,500 a month in rent for our office. Save it. And of course, the constant is 1 because we're just, again, this is a very simple driver setup where it's just a constant amount, so the driver is always going to be with the rate of 1. We're just saying 2,500 times 1, right? But this is where you can do the formula building, so when you start getting into more complicated drivers, like taking, let's say, total payroll for the month, times a Social Security Medicare rate of 0.0765 to get 7.65%. So when you're doing the Social Security and Medicare tax driver, that's where you would go into the rate, let's say, and it would be 0.0765, right? And that's going to get multiplied by, instead of the driver being a constant like this, I can actually say is based on some other operating expense account, right? And then the account here would be my payroll. And I don't know if I actually have payroll in this chart of accounts yet. It doesn't look like I do. So I would choose payroll, or let's just use rent and lease, right? And it's giving me a circular reference because this is also outputting to rent and lease. So that's a bad idea. I could use any other account. So of course, if I had a payroll expense account in here, I would choose that. And of course, this is going to get me a result of 0. But I just wanted you to see the picture of how this works. I'm not sure why it's giving me this error, because we're outputting to rent and lease. The driver is based on repairs and maintenance, current month. Anyway, you get the idea. Let's go back to what this should look like for a rent expense, which is going to be a constant of 1. Sorry, the driver is a constant of 2,500. And the rate is a constant value of 1. Okay, and now I can go back to my operating expenses table up here, and I can see that my driver works, right? I get the 2,500, and of course now I'm getting my operating income at $5,000. Why? Because I had 7,500 in gross margin minus 2,500 for the rent, right? That's the total OpEx, which is picking up from the actual rent and lease line, and that's how I get my 5,000, and it gives me the operating income percentage, which again is how I start getting the analytics, the KPI stuff, where I can see, you know, I should see a fairly consistent operating income percentage, and I should see that cycle with whatever expectation I have in regards to how my business cycles, right? And so, you know, I wanted to keep it very simple and sort of high level for today, since this is my first look with all of you at how to use the Jirav product. And of course, what I can start to do as I get this filled in and as I build out more and more of these drivers is I can start to then compare. You know, I can go into the report section here and I can start doing my comparison. So the report section is also very robust. Just like you could manage plans to set up the different driver scenarios, you can manage your reports, right? Manage templates, and I can lay out these reports exactly the way I want. They have kind of a default executive summary based on what a lot of people might want to see at a high level, which of course is going to show you an overview, right? Everything really from your P&L broken down into the major categories: revenue, cost of goods sold, gross margin, operating expenses, operating income, right? Other income, net income, and then cash.
So if you had an active QuickBooks company that you had connected, it would be bringing in all your actuals for the first.
Yeah, and I do have some data there. As you can see, I've got cash balances. But it's a sample QuickBooks company that I use to do videos and things. So I don't have it really fleshed out. What I'm going to do as I do more of these videos on Jirav is I'll import, you know, actual data into the QBO company, so we can start looking more clearly at what the, you know, comparatives look like. But if I go, for example, to an income statement here, right? So here's just showing me, you know, year to date so far, I have commissions income of 60,000. I have some fee reimbursements, commissions paid. I clearly had used this recently to do an example for a real estate concern, right? But when I edit these columns, I can go in here and say, well, the source from column 1 is going to be the current. Remember, this is what we called the current plan. We called it 2020 current, right? And it has no column 2. What I could do is say, compare this to the actuals, right? And we can say, let's do it for the previous period, which I don't have any drivers set up for the previous period because we just started this effective May, right? And I don't know if I have anything for May in the actuals. Let's try it. So I'll say column 2 is going to be the actuals for the current period. Column 1 is going to be the projections, which is the 2020 current plan for the current period. And let's see if we get anything sort of meaningful here. We may not yet, because like I said, I haven't fleshed out the data real thoroughly, because today's purpose was mainly just to get you in and, you know, sort of get your feet wet, so to speak, with how to build the drivers. The variance analysis sort of comes later. So yeah, it looks like, oh, you know what else I need to fix? Notice it's going from the beginning of the year. So the period we want to make just for this month, right, for the current period. And let's hit save and apply and save. All right, so that's a little bit more like it in terms of the picture. So now you can see, presumably our projected revenues for May are 7,500, but the actuals are 250,000. So we kind of kicked the pants off of our projections. Now the negative versus positive and the delta, that's what this is called. This is the dollar change. It's negative because the way Jirav works is it consistently applies, whether you're in revenues or expenses, it consistently applies the application of the subtraction. So it's taking column 1 minus column 2 always, right? So there's some things you can do in the settings here to make it a little more visual so it's much more clear. Is the variance favorable or not? Clearly this would be a favorable variance. So we might want to see a favorable variance in revenue as a positive number, but keep in mind if you structure it that way, that means your favorable variances in expenses are going to be a negative number. But the way you can flip this, if you need to, is just in the columns. So instead, I make column 1 the actuals, and I make column 2 the 2020 current. Save that. It will flip them around. So now I see a little bit more of what I would expect to see in a favorable revenue variance, that the actuals are now in the first column. We did 250. The projected number was 7,500, you know, and so that was a 97% favorable variance at this rate. Now, the other thing you can do is if we go into, it's not in the edit columns, it's in the edit. Nope, sorry, backing up. Over here, there's this little icon that shows like a $sign, a percent, and a number. When I click in there, I can change some other settings. So I can say a negative number is going to be in brackets like this, right? I can leave that, and I can say if the variance is favorable, make it green, and if it's unfavorable, make it red, right? All right, then you have some settings as to how to show decimals. You can round things, you know, so you can really be specific as to how this gets presented. But after saving those changes, I have to talk to them. This is why I wish Blake was still here. It should be showing, wait, it changed my other settings. Let's go back to columns, right? So report period is supposed to be this month. Okay, report columns is months, that's fine. This is current, this is actual. I don't know why this all got reset. Current and current. Oh, I went into the executive summary. I meant to go to the income statement. Let me make sure I set this up in the right place. So that should be green, that should be red. There it goes. Now it's working. So what it does now is I can clearly see green is good, right? Red is bad. Here we paid $5,000 in commissions, but we didn't have any projections for commissions. So it's an unfavorable variance. It's red, right?
Does it only do the high level?
It only does the totals. It doesn't do in between. I've had conversations with Evan from Jirav about why that is, and he had a logic to it. I just don't remember exactly what that was. But we can, you know, again, I'll definitely be doing more Jirav presentations where I'm sure if Blake were still here, he'd be able to explain. But there was a logic to it, and it had to do with where it would get, I think, very complicated to you know, to do it in the detail, so to speak. So yeah, because I would love to see these, you know, in their appropriate green or red so I can see. But so the bottom line is you look for the red and then you look in here and analyze it and see what do we need to take a deeper look at. And it gives you the percentage. So oftentimes when we're doing variance analysis like this, we have a threshold set based on a certain percentage. And we want to look at anything with a variance based on, let's say, a more than 5%. And we usually do this based on more than 5% either direction. Just because a variance is favorable doesn't mean it's good. First of all, if we have a favorable revenue variance and it's a significant one, that could very likely indicate that we've left something significant out of the projections, right? So it's not necessarily, you shouldn't just assume because it's favorable that this is good. Oh, we don't have to worry about it, right? So it's, you know, it's important to take a look at every variance that you consider to be significant, which a lot of companies use, I think 5% as kind of a benchmark for that. If it's more than a 5% variance, we should look into it and we should have some kind of a documented explanation about why we had that variance one way or the other. So that's my story. I'm sticking to it. You know, we'll do more on this and you'll get to see, you know, what this looks like as it gets more and more fleshed out with data. But of course, what I encourage you to do is go to Jirav and take an account with them and try it out. Because you can already hopefully start to see where this is a very powerful and robust tool. And, you know, you'll see how this can, I'm just looking at the chat here. Oh, I think Alexa meant to say great look inside or peek inside. Okay, perfect. You'll see how powerful this is, and then you'll start to think in terms of, okay, as powerful as this is, and as much time as this saves, creating a very clear and definite and detailed, you know, cash flow targeting plan, you know, how much is that worth? What should I be charging for this? You know, and in my experience, if you're going to do this kind of CFO level service for a company, the fees to charge should be minimum $2,000 to $2,500 a month for, you know, for providing a service like this. It's very, very valuable. It's literally taking the blinders off of the company and saying, let's lay out a clear trajectory in terms of, like I said at the beginning of the hour, how we're going to get from where we are today to where we want to be in a year from now. And especially when I can specifically plan the cash target and say, you know what, let's lay out a plan for how we're going to get from an average monthly balance in the accounts of $30,000 to an average monthly balance free and clear after bills are paid of $100,000, right? That's how we can really lay out a plan that will show us how to build the cash reserves. And that way, when you do it from this perspective, what you're factoring in that a lot of times we don't factor in, and therefore we don't really impress this upon our clients, is how much money they're sucking out of the business in distributions. That's often the biggest, you know, most like sort of incriminating thing that business owners do to their own companies is they suck it dry by pulling all the money out. And then they give us that, they ask us that classic question. Hey, my P&L says I made all this money, but I don't have any money in the bank. What happened? And it's like, well, you took it out. And they usually don't believe you at first. And then you go and show them, and you drill into that owner or shareholder distributions account and show them the list of payments they made to themselves. You know, do we need to compare this with your personal bank account so you can see the deposits that came in as you took all these payments out? You know, and I've had that conversation with clients, and of course I always try to be funny about it, because once they see it, they get like almost this sheepish look like, oh yeah, I guess I did take a lot of money out. And I've shared the story. I shared it recently in the video series I did on the Bulletproof Bookkeeping launch, and it's a true story. I had that exact conversation with this client one year, many years ago, and he's like, there's no way I took that much money out. And when I dug into it, there was one transaction that really jumped out because it stood out from the rest, because it was a check he'd written himself for $75,000. And I always, you know, I always share this because it makes the point, and because it's a true story. I said to the guy that I hope someday I'm so rich and famous that I can miss and forget about a $75,000 check I've written myself. And he laughed. But the thing is, he came at me initially accusing me of having screwed up his books. He was like, there's no way these books are right. I didn't take that much money out. I said, okay, let's, you know, I always give him the benefit of the doubt and say, well, maybe I did screw up the books, but let's take a look. You know, let's go to the videotape and see, right? I love saying that. Let's go to the videotape, right? See, accounting is exciting. It's just like watching a sporting event. And we, just like they do in sports, we can say, let's go to the videotape and let's look at the record. Who said that famously? Was that Nixon? Let's look at the record.
Wasn't it this guy in LA that would always say, let's go to the videotape.
Well, yeah, go to the videotape was one of the famous sports announcers. Was that Marvin? What's his name?
No, it was somebody with a W.
I don't remember. But let's look at the record. I think was Nixon.
Yeah. So somebody started to ask a question before I interrupted.
I was just going to ask about the accountant program in Jirav, how it, because I know it's $99 per account, right?
No, that's for the like low end product, which doesn't nearly do what you saw today. It's like just a very sort of simple kind of KPI type product. If you want the full Jirav experience, it's the retail sort of price is $250 a month. But that's why that's why I wanted to make the point that if you're going to do this for a client, you should be charging at least $2,500 a month. So then it's no big deal to include $250 a month for this in the mix. But so it is, I believe, retail $250 a month, and then the accountant program, I think you get like a $50 a month discount. So you end up getting it for like $200 a month, something like that.
Okay, I thought I'd seen $500 a month. I'll
a long time ago, I think they had originally priced it there, and I think they realized it was going to be hard to get small businesses and those who serve them to buy in at that rate. So they dropped it. But I believe now it is $250 a month. And I just include it. You know, when I have clients who I can bring on at this, at this level, the fee is $2,500 a month minimum. And that's for a fairly simple, like a marketing company where there's not a lot of complex drivers I have to create and manage. It can get more complex than that. Like, I think, again, my opinion, for a client where, let's say you're doing everything, including all the bookkeeping and all the way up to this level, the CFO, when you're doing the entire range, to me, that's a $5,000 a month client to do both the whole bookkeeping process and the projections and do the variance analysis. Because in order for this to be effective, you really also need to include at least a monthly 1-hour call to review this with the client, right? Because you know very well, if you're not reviewing it with the client, they're not reviewing it on their own. If they do, it's going to be very cursory and superficial, and they're not going to get the real value out of it that there is the potential for them to get. So again, my opinion, but I think that all has to be factored in when you're delivering this kind of a service to a client. And you have to include the fact that almost by, what's the word I'm looking for? Almost by necessity, it has to include at least a 1-hour monthly review. Especially in the beginning. Maybe after a while when things get going and it's pretty smooth and there's not a whole lot of variances, maybe you can back that off to quarterly. But I think at least in the beginning, it needs at least a 1-hour a month meeting where you can review the variance analysis with the client and talk about that, because that's how you make sure that you are on track to meet with the goal. Because if you set this up and then ignore it, all you're going to end up with is a whole bunch of months with unfavorable variances that ultimately are going to flow into, we didn't hit our targets. Right? The only way you're going to ensure that you hit your targets and keep that trajectory in place is if you're constantly revisiting this and seeing where you've gone off, and based on it, seeing where you can compensate, right? So if I spend way too much on an expense category, I mean, one of my clients that I do this for, before all the COVID stuff, he did some traveling, and his travel expenses were way beyond what we had in there. Now, was there a good reason for the travel? Absolutely. But the point is, if we wanted to hit our cash flow targets, we had to make up for that somewhere. And of course, in that case, his idea was the costs he was spending on travel that month would be made up for in increased revenues that would be coming in the next month or 2 or 3. But the point is, by doing this and having that process, which forced that conversation, we put our attention on it, and we were paying attention to it and making sure that we were able to compensate for that. Otherwise, when he gets to the end of the year, he's going to look at me and go, Seth, we had a projection that said I was going to have $100,000 in the bank. How come we're still back to $30,000? And then at least, not that this is the answer I really want to have to give him, but at least then I could say, well, you spent a whole bunch of money on travel that wasn't accounted for, and it didn't bring in the revenue that you predicted it was going to bring in, So there's a lot of important value that has to be put into place here. Again, this is the kind of tool and the kind of service that has a lot that has to come with it. And so hopefully I've now made that impression upon all of you that it has to, by necessity, include one-on-one time with you and the client. There's no way you can do this without that. It won't work. Let's put it that way. You can do it, but you're not going to, if you hit your targets without doing that, it's going to be by luck, right? So anyway, just take that into consideration.
Have you had any experience importing from Excel when you don't have somebody in QBO? I've got a fiscal sponsor situation where I get reports and I need to do analysis.
I have not specifically, but I can tell you this, for each company that you sign on, they give you a few hours of one-on-one support. So I'm sure they can walk you through that and make sure that it's very clear. You know,
Yeah.
try it on your own. From my experience, it's probably simple mapping where you would just establish what line item in your spreadsheet goes to what line item in the chart of accounts. But again, you can use that support that comes with each company that you set up, and
Cool.
and they'll walk you through it. Evan is the guy who I've had helping me, especially when I've got into really complex stuff like the debt service, and he's been amazing.
Cool.
So, and what I love about Evan, by the way, is he is a guy who was a customer of Jirav, and he fell so in love with the product that he went to work for them. So anyway, so he understands it really well from both sides, which puts him in a great position to be able to train people like us when we need the support, you know, for how to use the product. Because again, there's going to be a learning curve. Don't assume that this is going to be easy. It's not. If anything, assume it's going to take some time, and you know, so be prepared, and hopefully you're willing to put in the time, because I think the payoff is going to be incredible when you can learn how to do this with clients. And then once you learn how to do it with one client, you can replicate it over and over again, especially if you have a niche where all the clients are pretty similar. The only time you'll have another learning curve is when you're dealing with a new kind of client and maybe a different sort of style of how you have to do the projections, or you get somebody with a big debt structure where you have to build out something a little more complex like the debt service tables, you know, so things like that will come up along the way. But like I said, they have amazing support, and I've been working for a long time towards being able to just do this much with you all. And so my plan, of course, is to build out a lot more content. And I've mentioned to our 97 and up friends recently that I'm in the process of developing sort of the next level up from the Bulletproof Bookkeeping program, which is called Bulletproof CFO. And this is very much going to be a part of that mix. I'm going to be teaching people one-on-one and at the group level how to build the projections in the spreadsheet first, so you have that understanding that we talked about in the beginning, and then how to take it into Jirav so you understand how to build this product and bring on a client of your own. And part of the program I'm in the process of developing is going to include the opportunity for you to go get your first client in the service, and then I will work with you developing your actual live clients' projections so that you really get the experience. And of course, back of that is the opportunity to do it for your own practice. And that's the best way to learn, is build one for yourself first, do it for yourself, and then you're in the best possible position to start doing it for others. And on that note, I'm going to let you all go. I don't want to hold you hostage, and I have another call coming up in like a minute, actually -2 minutes now that I look at my clock. So I will
Better
see
go
you.
then. Thank you. Have a good weekend.
Thank you. You too.
All right.
This has
Bye.
been great. Thank you.
You're welcome.